Good morning, good evening, good afternoon to you, trader, no matter where you are in the world. It's your boy here, the Forex Amateur. And this morning, I wanted to speak a little bit about a very important concept when it comes to price action trading, right? Now, this is in no matter what market environment that you operate in, there is an element of the specific uh, concept in that market environment, right? And I noticed that this is something that a lot of people do struggle with. Even though my plan was to put out content from around the third quarter of this year, this is basically a very important concept that I realize a lot of people are having issues with. So I said, let me just make a short video and perhaps somebody might be able to benefit from this. So enough with the suspense. Let's just get straight into it. But before we do that, remember, I am not qualified to offer financial investment or trading advice. Everything I speak about on these videos is purely my own opinion and my approach to the markets. I do not recommend any specific trading strategy. I do not recommend a specific market environment or instrument or trade or anything like that. So neither do I recommend trading with live funds. So if you do, those are decisions that you make on your own side. Everything on this video is for educational or entertainment purposes. So let's talk about the conversation for this morning. So the topic for this morning is the ancient question of market structure. Right now, this is a conversation that's going around a lot. Right, there are a lot of people that speak about market structure, and of course, everybody has their own little spin to it. Because when it comes to trading, it's important to understand that your personality plays a lot of the role in what you're going to do as a trader, or your type of trader, or your type of environment or instrument that you want to trade, right? So for myself, everything I speak about on this video is purely going to be my own approach that I look at, right? Now, what is market structure? In any market environment, there is an element of market structure, because market structure basically shows you the buying and selling of participants, right? Or it shows you the movement of money. Where are people buying? Where are people selling? Where are more people buying and where are more people selling? So if you want to call it some sort of a derivative of supply and demand, right? Obviously, I don't subscribe to that, so I don't really use supply and demand, but I do obviously use it every now and then to communicate a certain point. So let's talk about what is market structure. For me, market structure is simply the movement of money, right? Movement of money from buyers to sellers or from sellers to buyers. And number two, it is an element of dynamic support and resistance, right? Dynamic SNR. I'm just going to call it SNR. So dynamic SNR, right? So that is what I call market structure. The reason I call it a certain type of dynamic support and resistance, bear in mind, I do not use support and resistance for trading, right? But this does give you some sort of an element of support and resistance. And as we get a bit deeper into the conversation, you will begin to start seeing those elements of support and resistance when it comes to market structure, right? Now, talking in market structure is basically going to give you a roadmap of the journey of price, right? It's going to give you a roadmap telling you, okay, price took off from here and did a pit stop at this area, maybe got some refreshments, topped up on some energy drinks for the road, and then got back into its car, and then it drove from here to this point, and then it did this and did that. So that's what market structure is basically going to highlight, the journey of price. And once you are able to effectively identify the journey, it's easy for you to position yourself and sort of ride along, right? So a very silly example that I like to use is, if you want to get from from Durban, South Africa to Johannesburg, then you're most likely going to jump on a bus that's going to Johannesburg. You're not going to jump onto a bus that goes to Cape Town, right? So what I'm basically saying is, if you can look at market structure and you can identify, okay, this is the journey, right? And obviously all of the other things that you look at is telling you that, okay, price is most likely going to go from here to here, then it's much easier for you to position yourself in that area and ride that wave, right? Because it's important to understand as well that a lot of retail traders fail. So the reason for that is that we obviously are doing something wrong, right? So what you want to basically do is, when you look at the market and when you take a trade and it hits your stop loss, somebody is benefiting from your stop loss getting lost, so getting hit, sorry. So why not position yourself in that area in the direction of the person who's winning? Does that make sense? So that is basically what I am looking at. Now, there are obviously two phases when it comes to market structure, right? So market phases. There are two phases. Now, what are those phases? Number one is impulse, right? So the impulse phase. When you look at market structure, price is going to be doing one of these two things. It's either going to be in an impulse, meaning it's in a push stage, right? So this is another term that people use. I'm not sure all the other terms, but this is the two that I'm very familiar with. Impulse or a push, or correction or exhaustion, right? So price is either in one of these two stages, regardless of what chart you look at, right? Now, let's talk about some of these things that we've already covered so far. Now, obviously, we've said that prices, when it comes to the market phases, price is in one of two stages. Now, I'm sure if you are familiar with trading, or if you're new to trading, one of the things that will stick out to you when you look at a chart is there are instances where price is moving like that, and then it's moving like that. Or there are instances where price is moving like that, and then it's moving something to that effect, right? Obviously not so clean. I'm not the most artistic person in the world, but this is basically more or less what you would see on a chart, right? Now, in order for you to identify, let's just use, wow, let's use this so you don't have to deal with my drawing, right? So something like that, okay? So there are instances where price is obviously moving something like that, right? And then obviously there are instances where price is moving something to that effect that is no better than the lines that I drew before, but hopefully it does communicate the message. So price has done what in this instance? It has moved from this point to this point, right? That is the overall move that this price has made in an upward direction, right? Now, what you're basically trying to identify is in which phase is price currently, in which market phase is price currently. Now, obviously, at this point, you would be somewhere around here, right? And you would be able to effectively identify what is an impulse. An impulse is a continuous movement in one direction where price has a lot of volume, right? Another thing that you could we could add to this area here is it shows momentum, right? So market structure is a indicator of momentum, right? Because if price is, or you, sorry, if you look at specifically which direction does the impulse flow in, that is how you are able to identify in which direction is momentum. Now, if you were to see this on a chart, right, and you can see, okay, price made this continuous move from this area here up into that area, continuous, right? Very straight. You're not really going to see this much on a chart, but more or less there'll be some sort of movement inside here, but the continuous move would be to the upside. This is obviously indicating that the momentum in this is to the upside, right? Why am I saying that? So if you look at this side of the chart, so if you look at the price moving from here down to this area, how did it move? Was it a continuous move like this, or was it more choppy? Did price pull back and push multiple times, right? Now, it's obviously important to understand that dependent on what time frame you are using this on, it will have a variance of structure on a lower time frame. What that means is that basically, if I grab my pen for a second and change the color, is that basically inside of here, there will be some sort of a appearance of the two market phases within this push, right? So that means that inside of here, there will be some sort of an impulse from there to there, and then there'll be a correction in this area, right? Then again, there will be an impulse from here to there, and there will be a correction in this area. Then again, from here to there will be an impulse, and then there will be a correction in this area. Similarly, on the side, there will be an impulse, and then there'll be some sort of a correction. There will be an impulse, there will be some sort of a correction. And this is where basically it does get a bit confusing for people. So it's important to understand that on every time frame, there will be a presence of market structure. What you need to do is you need to identify the market structure on the higher time frame, and that is how you position yourself in terms of your bias, right? So what is this basically saying? So if market structure on the higher time frame, whatever you want to call your higher time frame, whether you're a day trader and you look at the 1 hour chart for your bias, whether you're an intraday swing trader and you look at, or a intraday trader or a swing trader and you look at the 4 hour chart or the daily chart for your bias, on every time frame you will see your elements of market structure and you will see price moving in these two phases. What you need to identify is on your highest time frame that you use for trading is which direction the impulse is happening in, and is it valid in relation to the entire scope of what's happening on that chart, right? So if you look at, say, for instance, you're a day trader and you use the H1 chart as your higher time frame. If you look at the H1 chart and you see something like that, and then you see something like that, then you know that in this instance, the best thing for you to do is to look for buys. If you look at the, if you're a swing trader and you look at, say, the daily chart for your bias and you see something like that, and then you see price doing something like that, then you know that in this instance, the best thing to do is to look for sells. And that is simply what you're going to use market structure for. Obviously, you can use it as an entry indicator or an entry trigger or whatever you want to call it. But fundamentally, you can use it to position yourself on the right side of the market. Because a lot of people do say, one of the things I've come across is people say things like, if I am able to identify my bias, I would be able to be much more profitable in the market. And this is very true. Not that this is some sort of a secret that's going to give you the biggest edge over the market, but it's going to give you enough of an edge for you to be able to position yourself appropriately. Obviously, another thing you need to look at is how to enter, when to enter, where to target, where to take profits, where to set stop losses, what validates, what invalidates your trade. And perhaps during the course of these sessions, or if I do another video, I'll be able to break it down a bit more. But I obviously don't want this video to be too long, so I'm not going to speak too much about that. If you want to, you can always go and research it on other providers, right? So looking at that, right, we've obviously covered the market phases, which is push in this instance, exhaustion or correction in this instance, push in this instance, exhaustion or correction in this area here, right? So it's important to look at it. Let's break it down a little bit more now. What is impulse and what is exhaustion, right? So impulse or correction, let's just call it impulse and correction, because that's, I believe a lot of people are familiar with those terms, right? So what basically gives you that sort of understanding of, okay, this and this and this and this has happened, so this is an impulse, or this and this and this has happened, so this is a correction, right? How are you able to identify that? For that, it is very, very simple, and let's look at that really quickly. So, for instance, now we do know that the market moves in one of two directions. It's either moving up or it's moving down. And I say this, a lot of people will say sometimes there's that third direction where it's moving sideways. And I don't really believe this, right? One of the things that stands out for me, oh, wow, okay, that's much better. One of the things that stands out for me is that even if the market is tend to move sideways in this instance here, in these little pushes inside here, there are elements of impulses and corrections, right? So regardless of whatever time frame you're looking at, even if the market is moving sideways like this, there is some sort of an impulse and a correction inside of that. So that's why I say there are only two directions that the market can move, either to the upside or to the downside, right? If you can hear that alert, I apologize for that. That's probably one of my alerts going off for one of the setups I'm watching. But anyway, we're invested in this video, so let's talk about it really quickly. So how are you able to identify, okay, this is an impulse to the upside, or this is an impulse to the downside? And there are two very, very simple things that you can look at to identify that. Firstly, one of the things that you need to understand is what is bullish market structure and what is bearish market structure. Because if you are able to identify those things, then you are able to see, okay, in this instance here, the market structure is bullish and there still is much more impulse to the upside than there is anything else. Or in this instance, the market structure is bearish and there's much more impulse to the downside than there is anything else, right? So what are the things that you need to look at? And for me, there's two very simple rules that I follow when it comes to identifying that. But obviously, you have to understand what is bullish market structure and what is bearish market structure. And for that, very simply, a market is bullish. A market is bullish if it is making, number one, higher highs. I'm just going to put it as HH, higher highs and higher lows, right? That is a bullish market. So if a market is making higher highs and higher lows, then it is a bullish market. Let me just move this all over, but perhaps if I can't, let's move this there. Let's move this closer there so I can draw in between, right? So a bullish market is making higher highs and higher lows. What does that mean? Basically, when you look at the market, you will see something like that: price push, pull back, push, pull back, push, pull back, push, and so forth and so forth, right? Obviously, it's not going to be clean like this, and hopefully as the discussion does progress, I'll basically go a bit more in-depth in terms of how to look at more complex versions of this. Now, looking at this, what is this market currently doing? So if you are able to identify what you need to look at is, firstly, you're going to look at, okay, this is a low point and this is a high point. And we're starting from here because we have no other information to the left-hand side of the chart. So this is a low point and this is a high point. Now, what is this? This we would call a higher low. Why is this a higher low? Because you simply compare it to the previous low, and this low is higher. What did it do after here? It created a higher high. Why is this a higher high? Because if you compare it to the previous high, it is higher. Thereafter, it pulled back, and this is another higher low, another higher high, another higher low, another higher high, right? And how do you identify this? By simply comparing to the previous high that it formed or comparing to the previous low that it formed. So in this instance, this would be an example of a bullish market. Why? Because it is making higher highs and higher lows, right? So that's obviously the first thing that you would look at. And I'm just going to clear this. Oh, man. I can't clear that whole thing off. So what I'll do is I'll just clear this because I do require this example again. All right, so we've identified that that is what a bullish market is. What is the second thing that we would use to identify a bullish market is? This is now where you get to the validation stage. The first stage is where you're looking at an evidence or what is the market is doing. And the second part is where you validate it. Because for you to say, okay, this market is bullish just because it's making higher highs and higher lows doesn't necessarily give you an opportunity to position yourself in any specific area. So what you need to have is a point of validation, somewhere where you're going to validate that this is a bullish market, right? So if you look at a chart and it's making higher highs and higher lows, all well and good, but where do you buy from, right? So what is the second point? The second point is breaking previous highs, right? Previous highs. That is how you validate that, okay, this is a bullish market. Why? Because it's breaking previous highs. So let's look at my little squiggly drawing that I did over here. So we said that this was a higher low and we said that this was a higher high. Why is this a higher high? Because if you look at it and you compare it to this previous high in here, what did it do at this specific area in here? It broke this previous high at this specific area in there. So this became a higher high because it's higher than this previous high in here, and secondly, because it broke above this previous high at that point, right? Now, that is what this would be a validation point. Now, that is a higher high, and then price pullback and formed a higher low. Now, if we look at the market and we're at this stage, then we can begin to look for buying opportunities at this area in here, specifically right there. Why? Because price has satisfied our bias, right? Or our bias requirements or our bias characteristics or whatever you want to call it, right? Why? Because firstly, this is a low, this is a high, then it formed a higher low. What did it do after forming the higher low? This is the most important part, is what? is where it broke market structure. When it broke this previous high in here, that is when we are able to identify, okay, from this point on, this market is most likely going to go bullish, right? And as you can see thereafter, what happened? Bear with me because this is a drawing, right? Obviously, but just looking at the example, we can identify that, okay, it pulled back after breaking above this previous structure. It then pulled back, formed this higher low, and this is where we would be looking for buying opportunities in whatever way we look at it, whether we use support and resistance, whether we use candlestick patterns, whether we use chart patterns or whatever it is. From this point onwards, we would become buyers in this market. And simply every time price breaks a previous high, right, and comes back and gives us confirmations at the new higher low, we would then become buyers again at that point, right? I can't really move it, so I'm just going to move this there, right? We would buy again at this point. Why? Because price is still forming. This high was above this high, and this low was above this low. So now price is continuously forming higher highs and higher lows. And what did it do at this point? It broke above a previous high, which means that when it pulls back, we would expect it. We would have the expectation that it'll form a higher low in this area and push up thereafter, right? Now, all well and good, you can understand that that is a bullish market structure. What would happen then in that case if price were to push from here, down here, up into there, and then rather than pulling back and rejecting and giving us confirmations here, price instead pushes down from here. So what do you do in that instance? Brian, what do you do in that instance? So very simply, let's just take this off the chart. Very simply, right? Your validation point is when price breaks a previous high, and your bias is based on price making higher highs and higher lows. So as long as price is making higher highs and higher lows, this is a bullish market. But if price breaks a high, right, or it doesn't necessarily have to break a high, maybe it even comes back to there and then pushes down, that is now when you start to change your outlook. You don't start looking for different trades, but you start to change your outlook. You now get evidence of price moving in a different direction. What does that mean? This is now your validation point, right? When it comes to identifying where price will change, because what is our base criteria? Price has to make higher highs and higher lows for price to be very bullish, right? So if price makes a higher high and then comes back and breaks the previous low, then you know that, okay, this price is perhaps not going to be bullish for much longer, but you obviously wait for now what would identify as bearish market structure, right? So bullish market structure makes higher highs and higher lows and breaks above previous highs. But in order for this to be your valid bullish market structure, it needs to, number one, break previous highs, and number two, respect previous lows. All right. So breaking a high, that's all well and good, but it also needs to respect previous lows. All that basically means is that if price is making higher highs and higher lows, it's bullish. And as long as, can you notice that what's happening here? After it broke this high here, it respected this low, because when it pulled back, it did not break below this low. It formed a higher low here and it pushed up again, breaking that high and respecting this low. When it came back, it respected the low again. And what did it do? It broke the high, respecting the low, right? So when price pulls back again, you would expect it to respect this low. That's a lot of X. You'll expect it to respect this low. If it begins to break below this low, that is when you need to start looking for possible evidence that it's most likely going to go bearish, because sometimes it can break this low and then it can come back, form a higher low, and it can keep going higher, right? So that's something we'll get into when we look at the more complex versions of it. But for now, higher highs, higher lows, respecting previous highs, breaking previous highs, sorry, and respecting previous lows is what a bullish market will do. So basically, for a bearish market, it will be the opposite. So a bearish market Number one will do what? It will make lower lows and lower highs, right? So make lower lows, lower highs. What does it do? Number two, it breaks. Look at everything opposite for what the bullish option would do. Breaks previous lows. What does it need to do for it to be a valid bearish market? It needs to respect previous highs. I'm just going to put it as previous. Everybody knows what that is, right? So the first part, the first one, number one in both these examples, number one is what it needs to do. So in a perfect environment, that is what it needs to do. That would be how you would identify a bullish or bearish market structure. How do you validate that it will be continuing? And that will be number two and number three, right? That is how you would be validating whether you should continue with that bias or whether you should switch to or start looking for different evidence or start looking for different indications that it is going to change trend, right? I'll get into that perhaps if I do another version of this video, and I'll get into the more complex understanding of it, right? So this is how you identify your bullish and bearish market structure. So bullish market structure will be forming higher highs and higher lows, respecting previous lows. That's important to understand. Bearish market structure will form lower highs, lower lows. And what is it doing? Respecting previous highs and breaking previous lows, right? Now, when you look at an example like this, you begin to understand what I meant when I said that market structure is a dynamic form of support and resistance, right? Because when this high gets broken, right, between this high and this low becomes a bit of a support zone. You would expect price to respect this low, even if it comes back, because it's going to form a higher low, right? Again, another one. When price breaks this high, right, you would expect it to respect this low. So from that high to this low becomes a level of support. When price, let's do another one. When price breaks this high, this becomes some form of a support zone because you will expect it to respect the low. So literally all you would be looking for is for price to come back down into somewhere around here, right? And then you would look to take buys, right? Obviously, you need to look for your other confirmations inside of there. Very similar in the bearish example. When price broke the previous low, you would expect it to respect the previous high. So this becomes some form of a resistance. When price breaks the previous low here, you would expect it to respect the previous high. So this becomes some form of a resistance. So that's what I mean when I say dynamic support and resistance. Is in a bullish market environment, as long as price keeps breaking previous highs, you would expect the previous low to be respected. So this is some sort of a support, right? So price has to, whatever it does, as long as it respects this level, it can go to the upside. You can then look for your double bottoms, look for your head and shoulders, look for your bullish engulfing candles, look for whatever it is, your moving average crossovers, if you trade those things, and all of those other things in those areas, right? And that is how you identify your market structure. So now, if price is moving quick to the upside and then pulling back to the downside, then that is your impulse, that is your correction. Your impulse is to the upside, and you expect the previous low to be respected. All right, so that is a very, very simple way for you to identify what is happening in the market, right? Now, obviously, when you're in a bullish market, your impulses will be in here and your corrections will be in here. Your impulses will be in here and your corrections will be in there and so forth, right? Forgive my drawing, I'm not the most artistic person, right? But your impulses will be in this area and your corrections will be in this area. You'll notice a very quick price action to the upside, and you'll note more of a corrective type of structure pulling to the downside, which means that if you trade your your falling wedges and your flags and all of those things, you will notice those things happening in these areas specifically. Similarly to the downside, if price is making lower highs and lower lows, this would be your impulse, and you'll notice a more corrective structure in this area. This will be your impulse. You'll notice a corrective structure in this area, which means at this point in here, when price breaks the high, comes back into here, in this area here, you will be looking for something that's telling you how to sell or how to get in, whether it is your double top, whether it's your head and shoulders, right? Whether it's, I don't know what else people trade, triple tops, bearish engulfing candles, harmonic patterns, and all of that other stuff that people trade, right? So that is where you will see in this area is where you will now see your reasons to look for sales. And that is a very, very simple way for you to be able to identify your market structure. So that's it for today's conversation. I hope that this shed some light for a few of you guys. If you like the video, just let me know in the comments. I don't really require you to like the video and subscribe and all of those other things, because I'm truly just putting out this content for people to benefit from it, right? So if you have any suggestions about anything that you were confused about on this video, or if there's anything that you want me to add and build up on this concept in itself, because there is a much more that I need to speak about this concept. But let's see how you guys receive this video, and we'll make a decision on whether we want to do another one. Until next time, I wish you a blessed and a profitable trading day, trading week, and trading month. Catch up with you guys later.